Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I am always on the lookout for companies with a ton of growth potential long term. That's what asymmetric investing is all about. And one that I think is underappreciated by the market right now is a very high growth shoe and apparel company that's On Holdings. The company probably makes products that you have seen around before, but it definitely doesn't have the name recognition of companies like Nike and some of the other big brand competitors. So I want to go through some of the metrics and what I see in the company's growth in this video today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to start with exactly what On Holdings does and what they sell to consumers. The foundation for On is really as a running company. That was what the company was started as. That's where this little cloud design, which is what they call the sole here, that is where that comes from, is from running. And specifically, some of their founders were long distance runners. So that's sort of the foundation. Over the time, the company has gotten into more casual wear, also into tennis and other sports. But you can see running still plays a major role in what they do. On top of shoes, the company has a large line of apparel. You can see some of those items here. You can also see that they're fairly expensive. The shoes are typically in the neighborhood of $150 a piece. So this is not a company that's going to go after kind of the low end of the market. They're really going for that premium segment. And that's really been beneficial to the bottom line and their margins. I'll get to that in just a second. Just wanted to show some of their other accessories. Again, like most sporting goods companies, they start with one product and then try to expand into other markets. One of the things I think is notable here is that On is actually a very big sponsor of some of the best female athletes in the world. So winning major marathon, major tennis events, it's actually been a phenomenal strategy for them. And I think we'll see them highlight that more and more in the future. Just to go to the overview of the company, give some details on exactly what investors are getting. Market cap is a little under $10 billion, so not a huge company, but still fairly sizable. Not much debt, 183 million. Cash and equivalents at 115 million. So a total enterprise value of $9.4 billion. From a price to earnings multiple standpoint, this trailing 12-month price to earnings multiple of 208 looks very expensive, but keep in mind this is a growth company and it's typically very difficult to be profitable and grow at a very high rate in a business like this where you're making physical goods. So I wouldn't worry too much about that. Enterprise value to sales is going to be probably a better valuation metric. And from a trailing 12-month basis, 5.4 I think is reasonable given the growth rate, which I'll get into in just a second. Now I want to start with the two items on this chart. The top line is the price to sales multiple. So I talked about that earlier. 5.5 times sales is what the stock is currently trading at. But why is that a reasonable multiple? Well, one is that the company's revenue growth is an astonishing 67% over the last 12 months. You can see this has not been a public company for all that long, but the growth rate is in excess of 50%. So when you have that kind of growth rate, you would expect a very, very high multiple, and a multiple that is much, much higher than competitors. Not quite what we're seeing. I pulled up Nike's numbers. Nike's price to sales multiple is a little over half of what On is trading for. So to put that into perspective, if the company grows at a 50% rate for 2 years, they're suddenly going to have a lower price to sales multiple than Nike. Here is the compound annual growth rate for On in the orange line, and then the green line is Nike's compound annual growth rate. Still a good growth rate, nearly 10%, but nowhere near the rate that On is growing. We can also go back to the snapshot. This is what analysts are expecting for growth for fiscal 2023, 24, and 25. 52% in 2023, 32% in 2024, 25% in 2025. So expecting just a ton of growth from the company. I want to go through a few comments that management said in the most recent conference call because they are expecting growth to continue. And there's actually a reason to think that the second half of this year might be better than they expected, at least from a reported basis. So this is their comment for the second half of the year. Our guidance implies a reported currency growth rate of close to 30%. Now, this is a Swiss company, so they report in Swiss francs. They go on to say this is equivalent to a constant currency growth rate of 44% for the second half of the year. So what exactly does that mean? Well, I pulled up the US dollar to Swiss franc changes. I'll go back to 1 year. This is the 1 year chart. And you can see that the Swiss franc has dropped pretty significantly compared to the US dollar. That makes sales in the US look smaller when you're looking from the Swiss franc perspective. Let's use an example. If last year they sold a pair of shoes for $100 in the US, and then this year they sold two pairs of shoes for $100 each, so sales doubled to $200, but the Swiss franc dropped 20% over that period of time, it would look as if there was only $160 worth of sales. So growth of 60% instead of on a constant currency basis being growth of 100%. That's exactly what's going on. But there has been a pretty big change over the last couple of months. The statements that I talked about earlier were recorded on this day right here, August 15th. Since then, the franc has actually recovered pretty nicely. So we may actually get a little bit better growth numbers if those numbers hold, at least on a reported basis. Ultimately, what's really impressive for On is the fact that they're growing at the rapid rate that they are. They're still profitable, and they have extremely high margins. Margins are in excess of 50%, much, much higher margins than you would see at a company like Nike. And that's what leads to the profitability of the business, despite the fact that they're growing this much, having to invest in inventory, growing sales and marketing, things like that. So I think this is one of these companies that can be a 10x stock over the next decade. I recently bought shares and I'm looking to add more in the future as well. But what do you think of On Holding? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.